When gold tops, it makes a high and doesn't come back to it. We've gotten over 2,400 3 months in a row, which shows that it's comfortable. You get back over there again, I think you're going to launch gold in a more dramatic way even, where you might be over 3,000 very rapidly, and silver like as well, leading the game. In fact, if you look at silver, gold's trading below its April high intra-month. April, May, and June have all reached 2,400. So it's just consolidating sideways when you look at a bar chart, including the highs and lows. In the case of silver, we're out above the April high. So silver's actually been stronger than gold despite the recent intra-month pullback in silver. So I think the monetary metals are the place to still be. I think the big move is still underway, has really yet to expose itself. And this time around, I think a lot of asset managers are looking at it favorably over the past few months especially, and also T-bonds.
The silver market is experiencing a deficit for the third consecutive year. Michael Steinmann, CEO of the mining group Pan American Silver, talks about the robust growth in demand for the precious metal, declining global inventories, as well as the company's opportunities and challenges when it comes to new mining projects. Precious metals are attracting increasing interest. After a long sideways trend, gold and silver have come to life. Meanwhile, consolidation among mine operators is progressing. For CEO Michael Steinmann, it is evident that silver will play an increasingly important role in the modern economy, especially regarding the energy transition to renewables. However, while demand is increasing, supply capacities will remain limited for the foreseeable future. There will soon be very little inventory left, says the Swiss mining executive with more than 25 years of experience in the sector. Consequently, any uptick in investment demand coupled with ongoing industrial usage could create a particularly bullish scenario. It's important to point out that silver has two primary drivers: industrial demand and investment demand. Last year, investment interest softened quite a bit, similar to gold, where you could observe consistent outflows from gold ETFs. Yet the price of gold held up relatively well, and this strength can likely be attributed to significant gold buying by central banks. Strong and growing industrial demand, coupled with a resurgence of investment interest, has driven the price up to around $30 per ounce. Obviously, if the Fed keeps interest rates higher for longer, this will have a negative impact on gold and silver or any commodity, since higher interest rates typically lead to a strong dollar. Nevertheless, we see very robust prices. And by the way, not only regarding gold and silver, but also in the case of base metals. How are you currently experiencing investor interest in silver? We're in a good spot right now, but there's still subdued investment demand. Don't forget, we're only sitting at around $30 per ounce here, while gold and copper are basically at all-time highs. Historically, silver has seen peaks above $50, so we're still some way from that. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
If you look at silver's highs since 2020, just on a bar chart, not that chart I sent out, which is the monthly close only, but if you look at a bar chart, you'll see there was a brief spike above 30 that occurred in 2021, very brief. I don't think there are any monthly closes up there. And then you retreated sharply, whereas gold had flat ceiling, got over 2,000, 2020, got over 2,000 again in 2022, got over 2,000 again in 2023. So it had a flat ceiling. Silver, on the other hand, had descending highs. While gold was going sideways, silver made lower and lower highs. So that 30 was the topmost peak of the pattern of descending highs. In fact, its last set of highs that it broke through was at $26. So we haven't even pulled back to there, and I don't think you're going to. Okay. So pulling back below 30 is not technically important. That's one single isolated old high over there that lasted, I think, a week. Okay, but most of the highs in silver since 2020 have been in the mid to upper 20s, not at 30. So it's not technically important. I know a lot of people think it is, but it's not. And I strongly suspect that the pullback we had in silver this week was it. That was the low, I believe. That was 28.73. Right now we're trading 29.60 something as we do the interview. I think when gold gets above that 2,400 ceiling, that it's defined 3 months in a row, meaning it's a happy level. It's not thin air up here for gold. Thin air is like the 2011 peak. Go back and look at it. When you hit 1,920, you collapsed. You could never even get back to 1,800 after that. Okay. Then look at the 2020 high in the year 2020 when we traded up to 2,070. When you dropped from that high, it took you 2 years to get back to that 2,000 level again. When you dropped, you dropped. Okay. This time we hit 2,400, pull back, 2,400, 24. Something's going on here that says, no, it's not thin air up here. The market's quite comfy. So people who think it's overbought, I think, are totally wrong. This is just a mild congestion zone. And when you get above that 2,400, especially 2,500, I think you'll see some drama that most people will be surprised by. Political tensions such as the threat of war, I don't think that's an issue. In fact, in my history of knowing gold since the mid-'70s when it was legalized, it's never really responded to a war event. There might have been a war event here or there, but it really wasn't part of a driving force behind gold. What drives gold? It's money. And when you depreciate the money units by which you value price gold, whether it's in euros or yen or dollars, and that unit of money is depreciating in value continually, gold goes up continually. It's as simple as that. And when you have a crisis that's pending, especially in certain asset categories that central banks don't want to see go down, stock markets, that's when they'll depreciate the money even more in their effort to put out the fire. They'll flood it with the new river of liquidity, lower rates and so forth, but mainly the river of liquidity. And you can bet they're going to do that. And the one spark that always gets them going is when their stock markets break. And I think that's what's pending. Now, I mentioned the structure on T-bonds on momentum. You don't see it so evident on price, but on momentum, we have this massive ceiling, which we've hit and hit and hit for 2 to 3 years now. And when you go through that, and you're going through it right now on momentum, you're going to launch.
In the continuation of the episode, Michael Oliver voices significant doubts about the strategies currently employed by the Federal Reserve, particularly criticizing their timing. In a recent discussion on liberty and finance, he pointed out that the Fed often delays its response to economic downturns, making its interventions less effective. This pattern was evident in their decision to hold interest rates steady at the latest meeting. According to Oliver, such actions suggest the Fed is always behind the ball, reacting too late to be of real help. Oliver also raised concerns about the accuracy of economic indicators that are generally viewed positively by the public. He argued that metrics such as employment numbers and real estate values are actually much more concerning than the government and mainstream media portray. This contrasts sharply with the stock market, which appears to be performing well on the surface, but may be masking deeper economic issues. Shifting the focus to precious metals, Oliver expressed a bullish stance on the long-term prospects of gold and silver. Despite the market's recent ups and downs, he believes that these metals demonstrate a resilience that speaks to underlying economic currents, rather than just short-term market fluctuations. According to him, precious metals are a more reliable indicator of economic stability, resistant to the superficial changes that can sway other markets. Now, we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
They usually are always behind the ball. Events happen and they say, oh, gosh. There's some analysts now who recognize and are even saying that they're going to be too late this time. In other words, the events will occur and then they'll have to panic. We already see economic data points that the Fed doesn't particularly want to mention, and I'm wondering why. But, the unemployment numbers are not good. The employment numbers are not good. It's only the superficial top line number is, and it's as if it's been doctored almost. It's all part-time jobs, And there's a lot of other economic metrics that are reflecting something wrong. Okay. Uh, Also, everybody's looking at tech. Nvidia and a few others. Apple right now popped to a new high finally, over 200, which we expected to see. Um, but when you look at things like, maybe we don't need banks anymore, but look at, KBE, the bank ETF, and look where it is. And look at RWR, which is it's a REIT, real estate investment trust ETF. And look where they are in relation to the price action of the last 2-3 years on the price charts, just simple as that. And then look at an S&P and say, these guys are in different universes, these asset categories. And well, maybe we don't need commercial real estate, maybe we don't need banks, But if you do, then pay attention to what they're doing, because this happened back in 2007 as well, when the stock market was topping out, which in late 2006, we thought it would top in 2007. We warned people, beware, it would top next year. And we had a zone where we thought they'd get to. And I'll be darned if they didn't get there. It was in September, October of 2007. But if you looked at the S&P then popping to a new marginal high, and the Fed had actually cut rates then, after a couple of years of rate rises, they cut rates 0.5 point. Remember, there's the underlying real estate crisis. But if you looked at banks and real estate type stocks at that point in time, they were in puke mode, okay? They were looking horrible, and yet the stock market was just full of glee. And then we had the disaster that followed. We think we're going to have another one. I don't like to applaud other fundamental analysts, but there's one in particular I do like a lot. There's Jeff Gundlach. He was on CNBC the other day commenting on that Powell talk. And he had basically our same view, and is one, they're too late, and no, we're not going to have a soft landing. He said it in very polite terms, but that's what we think. So anyway, that's what I see. I think that the Fed has already lost the game, and they're going to find out very soon. I suspect in the third quarter, the stock market's going to exhibit failure. They measure it via their own government ways, and it's not necessarily the way that the average family sees inflation, okay? But you got to realize that commodity prices, the Bloomberg Commodity Index, for example, exploded from a low in late 2020, well before that war ever started over there, and reached a high and peaked in March of 2022, 1 month after the Ukraine-Russia war started. So you can't blame it on that war. Commodities had already exploded, oil, grains, the whole deal. Since then, they pulled back. Commodities had a corrective pullback, about halfway back what they'd gained. And they laid low, commodities did, over the last year and a half actually, where after you drop from the 22 high, they went sideways. Oil dropped from 130 down to the 60 to 90 range, and so forth and so on. And so their metrics that they measure are lagged to what Bloomberg Commodity Index is doing. And their metrics are now showing a slowdown. Well, that's already been reflected in the commodity complex a year ago. Now the commodity complex, by our momentum metrics, is turning back up freshly. And no, it's not dynamic at this point, but there's too many markets within the Bloomberg. Energy's included in this, the grains and so forth, are starting to turn up in ways that we can measure that tell us, this is a real upturn. So what they're cheering now, their little modest downticks. You're about to get another wave to the upside in commodities. And this time, commodities will be in sync with gold. They weren't back in 2020 to 2022. Gold had already doubled at the point where commodities were just bottoming in late 2020. Gold had already gone to $2,000 from its low at $1,050 back in 2015. So, but now we're back in sync, where gold, we know, is surged. Monetary metals have, and the commodities are starting to turn up as well. And another event's occurring, I think, that is really a table pounder. And it's the T-bond market. The T-bond market, the very long end of the U.S. government debt market, 30-year plus, that got 20 to 30 year, has been under pressure, meaning rates rising as the prices go down. And it's been contrary to the stock market. As the stock market's risen since late 2022 in particular, T-bonds have gone down, yields have continued to go up. However, the technicals of the T-bond market tell us that there is going to be an upside explosion in the T-bond price action, likely to last for a couple quarters, so maybe several quarters, meaning a sharp drop in yields. And this is at the long end. We're not talking about the stuff that the Fed controls, the short-term stuff. And I think there's a reason for this. I think the reason is not good for the stock market. And I think likely this breakout that we're now seeing, as we talk now, this week, in fact, the T-bonds and TLTs, a popular ETF that's a good metric as well, are breaking out on long-term momentum, telling us that we're going to have a very strong move to the upside or drop in yields. What for? Why? It's not because the Fed's cutting. And plus, we're talking the long end. I think it's because there's asset class movement out of the high-risk stock market into the bonds for safety. Once again, that didn't work in 2022. Bonds went down with stocks. But since then, stocks have risen and bonds have continued down. I think they've now flipped. And that asset category breaking out to the upside, T-bonds, I think is now in sync with gold. Again, as an alternative place to be.
What do you think of Michael Oliver's take? Is he spot on? Post in the comments section down below your honest opinion on the current situation for the gold and silver markets. Thanks for watching, and now check this video right here because you'll love it. I see you on the other side.